Hello everyone, this is Venus Brown, and today in our Digging Deeper episode, I'm going to be looking at the tax considerations that I need to be thinking about for this first tax year after I've started up my business. In preparing to roll out this new small business venture, I need to make some purchasing and accounting decisions based on my tax situation. There are a handful of purchases I'll need to make soon, and I need to know if I will be using a standard tax write-off with amortization and depreciation, capital business startup costs, Section 179, or de minimis safe harbor. Most of this information can be found in the form and instructions for Tax Form 4562, the depreciation and amortization form. Some of the details concerning the tax rules and how this all works are a bit confusing to me. Let's take a closer look at the available options and what they will mean to my situation. And remember that I am only trying to cover the needs specific to my first year in business. I am a single sole proprietor starting an online consultation and coaching business with no employees and moderate startup costs. Your situation may be very different. Now, if I look at the Section 179 deduction, I can include the whole price of qualified property the year of purchase. This would be documented on 4562 in Part 1. But what is qualified under this deduction? This can be real property. Think of things dealing with improving real estate, such as roofing, heating, or AC security systems, and fire alarms. Or tangible property, such as second phone line or other communication equipment and furnishings. But it does not include property held for investment, foreign property, and property used outside the U.S., or property used by a tax-exempt organization or government unit. So far, it seems like I'll be able to include a small percentage of our roof replacement this year. The total cost of a cell phone may be used exclusively for business or partitioned off based on how much I'm using it for business or personal use. A chair that I'm going to need in order to replace the uncomfortable one I'm using now, and the desk that I plan to use for working at. I'm not certain, but I don't think a new PC, microphone, controller, and basic supplies I will need for this business will fall under this category. Depreciation is a deduction that includes certain business property that falls under a class type, such as computers, equipment, livestock, real estate, certain vehicles, etc. This will be documented on Form 4562 in Part 3. Based off a basis price, appropriate convention like half year, mid-month, etc., whatever method of calculation that you decide to use. Like a straight line calculation, I don't remember what the other main calculation type is, I don't use it. You would not have the entire expense for this item deducted all at once. If I need to depreciate them, my PC, microphone, and other similar classed purchases would have their costs values spread out over several years, starting the year that I begin using them for business. For my situation, it will probably just be my computer, and that will be spread out for 5 years. The basis for these items would come from calculating the percentage of each item used for my business. And since I plan on buying my computer just for the business, I plan to use the laptop that I am currently using for my personal purposes. I should be able to expense the entire computer. It will just need to be spread out for 5 years. Amortization is similar to a straight line depreciation. It's used to recover things such as startup costs, goodwill, and certain intangibles over time. This would be documented on Form 4562 in Part 6. My startup costs that are not expensed elsewhere should be able to be expensed all at once. There's a limit to these costs. And anything above that limit, which is $5,000 right now, would have the costs or value spread out for 15 years. But like I said, my startup costs should fall under that $5,000 limit, so I should be able to expense all of them at once, except for my computer, which I haven't purchased yet. It's going to be a fairly expensive purchase, and I plan on using depreciation spread out for that 5 years for its class period. Now, if I were to go over that $5,000 limit for startup costs, the remainder of those costs above that $5,000 would be spread out over a 15-year period, starting the year that my business begins, which will be this year. There are various other things that are expensed as amortization, like research, mining or drilling development, or circulation expenses. Of those, the only one I might need this first year should be those for circulation. And that would have expenses spread out over a 3-year period, except for anything that is included as startup costs under that initial $5,000 limit expense. These get reported as other deductions or other expenses. Now, I'm not likely to have any listed property this year, such as vehicles or entertainment type products used in a business, at least not initially. If I did, that would get documented in Form 4562, Part 5, and would use a depreciation deduction or Section 179 costs, depending. There is a section for de minimis safe harbor deductions. These are for amounts used to produce certain tangible property and are reported under other expenses. I have heard that it may be wise to be careful how much you list under these other expenses, as it could bring up a red flag for the IRC. I always called it IRS, but now I see that it's being called IRC. I don't know how true this is, though. I haven't accounted for anything I'll be using to start up my business that is necessary to document as this type of deduction, so I'm not too concerned about it. As far as I can tell, the items that can be expensed all at once are most of those that fall under Section 179 costs and startup costs. After that point, anything that does not get expensed all at once would need that cost spread out for a certain amount of time, based mostly on that class recovery period. 5 years for computers and equipment, 27.5 years for residential costs, etc. So far as I can tell, it does look like most of my expenses will be able to fall under startup costs, will be able to be expensed all at once. I'm still under that $5,000 limit, and I have purchased most of the things that I already plan to get. I still have not included the cost of a new chair, but that should still be well within the limit that I have set. I still have to get my computer, but that, as I said, I don't plan on putting as startup cost. That I plan on depreciating for its 5-year class period. And I don't believe that there's much else that I need to get. I have other supplies that I've already purchased. I have my desk and desk riser that I've already purchased. I already have file cabinets. Already purchased a little bit of lighting. It's nothing much. Still need to purchase a microphone, but I don't think it will be that expensive. I have purchased copy paper and some supplies. And I have purchased a new accordion file to put all of my tax stuffs in. I think I'm mostly set up. I just need to get that computer and that microphone and get on with it. So I am glad I did this Digging Deeper episode. It really forced me to look into the insurance codes and see what the policies were, how to follow the rules, and exactly where things need to be placed in the forms. All of that stuff that gets put on Form 4562 will also be transferred over to another form. They don't want to make things easy. No. We have to do one form, then transfer that over to another form, and then transfer that over to your actual tax form. I think that's everything for now. I will see you on next week's episode of Digging Deeper. Bye.